The Sure Investing Podcast, investments and strategies to help you safely compound your wealth over the long run. Returning from episode 3 of the podcast is Charles Fournier, a retired financial services executive who left the workforce in his mid-50s thanks to a high-quality portfolio of dividend growth stocks. My last conversation with Charles on the podcast provided a high-level overview of his investment philosophy. Today's conversation is a bit different. We spend our time talking in detail about each of his 10 largest portfolio holdings. Please enjoy this conversation with Charles Fournier. So Charles, last time we had you on the show, you gave us a really nice broad overview of your investor profile. And I thought a nice way to begin today's episode was to just start with a recap of how you like to invest. And I guess the characteristics that you generally look for in your portfolio holdings.
All right. Well, once again, thanks for having me, Nick.
My pleasure.
So I'm at the stage of my life where I took early retirement at 56 2 years ago. And what I had done was I started investing back in the 1980s, and my objective at the time was to create an investment portfolio over a lengthy period of time so that at one stage of the game, I would have companies working for me. I would have the little worker dividends that would send income my way so that I could step away from work. As much as I enjoyed my career, I only live on this earth once, and I wasn't planning on working until, I went 6 feet under. So I tend to focus on large cap stocks, and the companies that we're going to talk about today, these are names that shouldn't come as a surprise to your listeners. If there are some companies that they're not familiar with, just look them up and you'll see that these are the types of companies that have been around for a while, spit off profits on a regular basis, and they issue uninterrupted dividends. There are 3 in here, though, that had to maintain or hold their dividend during the financial crisis, but I'll talk about that as we go through them.
Awesome. And, I know that you have very particular thoughts on investing in common stocks versus REITs or MLPs or business development corporations. So do you want to touch on that for a moment before we dig into your 10th holding?
Yeah. So the reason I like investing in these types of companies as opposed to REITs and BDCs and what have you is I like to see a return on my investment as opposed to a return of my investment. And typically what I found is with the vast majority of REITs out there, they're constantly issuing new units in order to pay distributions to unit holders. And when you take a look at the tax forms, you'll see that there's generally a portion that might be capital gains, and then there's a portion where it's they've had to issue shares, so it's not always a return of your investment. And I also like investing in companies that are repurchasing their shares as opposed to constantly issuing new units.
That definitely makes sense to me. So, without further ado, let's dig into your 10th largest holding, which is Becton Dickinson.
Becton Dickinson. So I initiated a position in Becton Dickinson during the financial crisis. And what appealed to me was their business segments. So they're in BD Medical, which produces a broad array of medical technologies and devices. And then they also have their life sciences businesses. Now, subsequent to me initiating a position in BD Medical, and one of the reasons why BD Medical jumped out at me is because when I was out on the road for work, I would often drive by one of their warehouses. So I constantly saw the logo, and that's what prompted me to dig into them. So subsequent to Becton acquiring a position in Becton Dickinson, they acquired Care Fusion, and then last year they acquired C.R. Bard. Now, as a result of these acquisitions, they've taken on some debt. Their credit rating has dropped to somewhat speculative grade, but the profits generated through normal business operations are such that the company or management is optimistic that they'll be able to restore their credit rating to investment grade. So I wasn't about to give up on Becton Dickinson. It's a great company. They've rewarded me well over the years with increases in their dividends, and the symbol is BDX for any of your listeners who want to check them out.
Now, given the change in their balance sheet composition to fund those acquisitions you mentioned, would you invest in them today, or is it something that you're willing to hold with the caveat that you're expecting them to pay down that debt in the near future?
I would still invest in them today. I expect that they'll have no problems paying down the debt. As a matter of fact, I just automatically reinvest all the dividends that I get from them. So it's not as if I'm buying another 500 shares each and every quarter, but the price has come down. The valuation is a little bit more reasonable than a few months ago. So I guess it depends on your listeners' investor profile. Personally, I would buy another few hundred shares.
Now, your ninth largest holding is basically tied with Becton Dickinson in terms of concentration, to my understanding. So this next company is the Canadian Imperial Bank of Commerce, and to my understanding, this is a company that you're pretty bullish on, a company that you would buy today. So what are your thoughts on CIBC?
So CIBC, I worked in the Canadian banking industry for a number of years. I started off my career in the early 80s with Bank of Montreal, worked for them for 4 years, went back to university for my MBA, and then joined the Toronto Dominion Bank, worked there for over a decade, and then I went over to the Bank of Nova Scotia and worked there for about 12 years, and that's the bank that I retired from. So I'm very familiar with CIBC, the fifth largest Canadian bank. And funny enough, I rarely go into downtown Toronto anymore. But I did go last week and this week. Last week, I went to see a couple of my former team members who had moved over to CIBC. And coincidentally, I bumped into a third one who had gone over to CIBC. So I actually have 4 former team members who jumped from Scotia and went to CIBC, and one of them heads up the cash management group across Canada for both corporate and commercial. So and I had actually hired an employee from CIBC years ago to join me at Scotiabank, and I met him yesterday. So I'm somewhat familiar with CIBC. You know, I've hired people from there. Some people that I hired at Scotia have moved to CIBC. We used to bump into them all the time when we were bidding on business. Good bank. They made an acquisition south of the border in the States last year. They were always a laggard when it came to cash management services. They were what we considered more of a retail bank, but they certainly had a decent corporate presence. So I have no hesitation with my investment in CIBC. I invested in them years ago.
Now, one thing that stands out about CIBC for the quantitative investors that are listening is that the company kind of persistently trades at a discount to the other peers in the Canadian financial services industry. Why do you think that is, and how does that impact your investment thesis for CIBC?
Probably because they don't have the same kind of exposure as the larger ones, such as the Royal Bank of Canada and the Toronto Dominion Bank. CIBC used to be solely or primarily in Canada, and they were, the fifth largest bank by a long shot. So if your listeners actually take a look at the market caps for the Royal Bank of Canada, Toronto Dominion Bank, Bank of Nova Scotia, Bank of Montreal, then CIBC, and then National Bank, they'll see that National Bank is way down there. So they're always playing catch up.
That makes sense to me. Now let's move on and talk about, I guess, what's now your eighth largest holding, which is Canadian National Railway. I'm going to start, I guess, by asking you, when did you first purchase shares of this company and what made you buy them?
Once again, Canadian National Railway, that goes back several years also. The reason I bought them is they don't make any more Class 1 railways anymore. Back in the early 80s, I think there were roughly 40 or so. Now you have, Berkshire Hathaway bought Burlington Northern Santa Fe, so that takes out one of the publicly traded ones. But you'll have Union Pacific, Kansas City Southern, and I knew my mind would draw a blank when I started rattling them off. You have Canadian Pacific, and you have Canadian National Railway, and you have a couple of others down in the States. You don't get new railways that just spring up all over the place. It's not like other industries. The cost of setting up a railway is astronomical. So Canadian National Railway is one of the most efficient railways. Their operating ratio is typically well below its peers. They have a presence in Canada, from coast to coast, and they also go down into the States. One of the challenges that they've had lately is that they have really, really upset their customers in Canada, especially the grain farmers. There is a lot of animosity that the grain farmers have with Canadian National Railway right now, but they're trying to repair that. The reason why there's so much animosity was, one, there weren't enough locomotives, and there were a lot of engineers that retired and were not replaced. But meanwhile, the grain farmers are still producing grain. The stuff is sitting in the silos, and they have no way of getting this stuff to market. So Canadian National Railway has pulled back in price from a few months ago. So if any of your listeners are interested in looking into a railway, CN, they'll fix their problems, but they're typically one of the most efficient railways in North America.
Now, this animosity from the railway's grain farmer customers, is this related in any way to the departure of CN's CEO a month or so ago?
Yes. Yeah. So I guess he was tired of, being in the fire, so he jumped out. Yeah.
Interesting. Yeah, he was not on the job very long, because I remember when he was appointed, it was maybe 2 years or so ago.
Yeah, that doesn't give you a whole lot of comfort, does it?
No, but I mean, I'm sure they'll find the right person for the job. It's a big enough company that they have a really deep pockets to search for the right person.
Oh, absolutely.
Now, speaking of deep pockets, your seventh largest holding is a name that's going to be known to essentially everyone who listens to this podcast. It's Walmart. So tell us about your Walmart investment thesis and what got you started with this company.
Well, some of your listeners are probably rolling their eyes right now, and they're going, oh, geez, Walmart. Here's another person who invests in Walmart. I mean, why not invest in Walmart? Here's a huge company that is adapting to the changing retail environment. People make fun of Walmart sometimes. I don't care. It makes money. It services millions of clients. They're making a big push into, to compete against Amazon. They've stubbed their toe, but they have smart people there. They'll adapt. Walmart got to be where it is because they did a number of things right. And every once in a while, a big company will stumble a little bit. But if the management is good, they'll turn things around. So I have a whole lot of confidence in Walmart that they will be able to, tackle Amazon and all the online shopping. People thought that the acquisition of Jet would be the be-all, end-all for Walmart. When they did that, I went, you know what? It'll be a learning experience, and the retail environment is changing so rapidly that you have to be evolving. And I'm confident that Walmart is in a position where they'll continue to be one of the major retailers in North America.
Now, one of the challenges with investing in a company that is the size of Walmart, so this is a company that does something like $480 billion of annual revenue. One of the challenges here is, how can the company possibly grow to be any larger than it is today? What do you see as the major drivers of growth for Walmart moving forward?
Online shopping and prices of goods just naturally increase. Efficiencies. When I was working, we dealt with Walmart, and we saw all the things that they were looking at. Well, not all the things, but we saw a number of things that they were looking at doing to become more efficient, take out costs from their processes. They'll find ways to make money. Yes, they do squeeze their suppliers, but at the same time, their suppliers still make money. So Walmart just continues to find new ways to grow. They're not in every country in the world. There's still opportunities for them out there. $400 billion sounds like a lot. It is a lot, of course, but there's still opportunity for them to grow. And then just inflation. If you have 2% or 1% inflation every year, 10 years out, that 400 billion will be more than 400 billion.
Absolutely. Do you have any thoughts on the quality of Walmart's balance sheet?
I have no problems with the quality of their balance sheet. None whatsoever. And I haven't looked lately to see what they're rated, but they have they have a balance sheet where I can put my head on the pillow and sleep well at night.
Balance sheet discussions are a great way to segue into our next company, which has operated through a stressful operating environment over the past 3 years or so. And this is your sixth largest holding is energy giant Chevron. So what's your investment thesis on Chevron Corporation?
Well, they've had their challenges. That would probably be an understatement. It's the nature of the industry is that it's cyclical, and people talk about the advent of the electric vehicle, and some of these oil and gas giants, maybe not being nearly as profitable going forward. They don't just generate. Chevron doesn't just produce products that are used in the automotive industry. If I had to worry about an energy giant, it would be something like an Eni Spa out of Italy. I invest in Exxon, Total, and Chevron. I haven't gone into Shell or BP or Eni. I'll stick with the larger ones. They'll be able to adapt. It's a cyclical business. They have reserves that will last several years into the future. One of the things that I'm always concerned about in this industry is the environmental damage that they do, and that some ethical investors out there would probably never want to invest in a company like Chevron. But I am concerned about the environment, but at the same time, I have to put food on the table. I'm retired.
Absolutely. What kind of upside do you see in a company like Chevron as oil prices continue to mean revert to prices that are more in line with their historical averages?
I can see their stock price increasing and a restoration of their the typical kind of dividend growth that we used to see. I think for the last couple of years, we have seen nominal dividend growth. In some cases, some of these energy giants have had to resort to the use of debt to service their dividend. And some people would say, well, isn't that kind of crazy? Well, if you're an energy giant and a lot of your investors out there have purchased a stock, on the understanding that you are going to consistently get a dividend and it will increase. If you cut your dividend, you're you're between a rock and a hard place. So I can see how some of the energy giants have used debt to service some of their dividends. They've cut back on some of their capex and what have you. They're not fools at the top of the house. These are multi-billion-dollar companies, and I'm willing to bet that the vast majority of people who are listening to this podcast probably don't have the same level of expertise as some of the people at the top of the Chevron house. These guys know what they're doing. So even though they've had their challenges over the last few years, I'm not really worried that we're going to see a dividend cut. And if anything, I think we'll probably see their dividends rise within the next year or two.
At one end of the stability cyclicality spectrum is the energy sector, which is probably the most cyclical sector within the stock market. And at the other end, on the most stable side, is healthcare. So there's no healthcare company that's more well-known than Johnson & Johnson, which happens to be your next largest holding. What can you tell us about J&J?
Well, I like safety. So that's why I own J&J and Microsoft, the only two AAA rated companies out there. Johnson & Johnson has been around for eons. I've dealt with them from a work-related standpoint. They have smart people there. They are constantly acquiring companies. They have deep pockets. It's the kind of stock where you can expect growth. You can expect growth in your dividend. You can expect some capital gains, and you're not going to wake up one morning and turn on a news network and find out that the company has gone under. If your listeners are looking for a company with some consistency, Johnson & Johnson is the epitome of consistency. Just don't expect it to be shooting out the lights like a junior company where their revenue growth is in the double digits every year. The company is so darn large, you're not going to get that kind of growth.
Now, Johnson & Johnson has this pretty remarkable statistic that they always share in their investor presentations where they say, I'm not sure what the exact number is. I think it's 33 or 34, but they say we've increased our operational earnings per share for 34 consecutive years. And that's, most companies haven't even increased their dividend for that long. So there's definitely a lot of stability there. What do you see as the main driver of growth for Johnson & Johnson moving forward?
I see all of them as driving growth, but I know that they did an acquisition, a sizable acquisition within the past year, and the name escapes me.
It's Actelion, I think. Is that the company? Yeah.
Yeah. So, obviously, if you have bright people at the top of the Johnson & Johnson house that are investing, I think it was the acquisition something like $30 billion or whatever?
Yeah, I think so. And it was a Swiss company that got absorbed into their pharmaceutical segment.
If you're spending $30 billion to acquire a company, I think that's the growth area.
Yes, that definitely makes sense.
So you have, I can't remember the number of companies that fall under the Johnson & Johnson umbrella.
It's hundreds. I've seen that statistic too. It's insane.
It's absolutely insane. And so you have a bunch of companies out there, they're the cash cows, and what they do is they channel all their profits up to the top of the house, and the top of the house redeploys it as appropriate. It's like a publicly traded Berkshire Hathaway. People don't realize that Johnson & Johnson is just not one company. It's like hundreds of companies. And these hundreds of companies channel money to the top of the house, just like the Berkshire Hathaway group of companies. They channel money up to Charlie Munger and Warren Buffett, and these gentlemen deploy it as they see fit. That's Johnson & Johnson, but publicly traded. Well, Berkshire Hathaway is publicly traded, but you know what I'm talking about.
Yeah, absolutely. Earlier on, you mentioned that Johnson & Johnson is a very stable company, but you shouldn't expect them to deliver double-digit revenue growth like a smaller, faster-growing counterpart. And that, small, fast growing, that really describes the next company I want to talk about, which is your fifth largest holding, and its name is Church & Dwight. So by and large, all the companies we've talked about so far are going to be familiar to the people listening, and this might be the first exception for a large number of people. So I'm curious as to how you originally found out about Church & Dwight as a company, and what made you consider your initial investment.
Well, it was a company that we banked, and honestly, I didn't know the name Church & Dwight, but I knew Arm & Hammer. And so I started looking into the company, and I was suitably impressed. If you ask somebody, do you have any Arm & Hammer product in your kitchen, there's a strong probability that most people will say yes. And as I started looking around, it wasn't just the baking soda that people put in their fridge, but it's things like toothpaste, antiperspirant, the air filter that goes in the cabin of your car, the air filter that goes in the engine of your vehicle. I like to buy products from the companies that I invest in, and I have bought so many Church & Dwight products. When we had a cat and we had to we needed kitty litter, I always bought Church & Dwight kitty litter. I'm not a cat expert, but I didn't know that you could have so many combinations and permutations of cat litter out there. They seem to come out with different types of cat litter all the time. And then when I really looked at their suite of products, I saw that Trojan condoms, and I went, Nick uses tons of Trojan condoms. I got to make money from every time that he uses a Trojan condom. So, it goes from baking soda. It goes from baking soda to condoms to laundry detergent to Nair personal care products, and they also bought Waterpik. They have OxyClean. So if your listeners go take a look at the company's website, this company has been around for eons. And when I first invested in this company, it would have been probably around 2004, 2005, somewhere around there. Their stock has split twice, 2 for 1. Their dividend has increased every year. If I were to take a look at my average cost, and I should have done this before we started this call, my average cost right now is probably, I'm venturing to guess, maybe as we're talking, I'm doing this. My average cost on Church & Dwight is $13, and $13, and I bought I bought close to 1,000 shares when I first bought them.
Have you been dripping along the way?
I've been dripping along the way.
So tell us a bit about their capital allocation strategy, because this is a company that is, generates tons of free cash flow, and they have a very targeted way of redeploying it. So tell us about that.
Well, first of all, they reward their shareholders, and they're constantly looking at growing their suite of products. When you take a look at some of their investor presentations, what they do is they compare themselves to their peers. Their peers are much, much larger than them. You have the Reckitt Benckiser's, the Procter and Gamble's, and what have you. These guys know that they can't necessarily compete head on. So what they do is they reinvest in their products, and like you said, they have tons of free cash flow. They reward their shareholders. They grow their suite of products. They buy back shares. It's just paid at, well, they obviously take on debt when they acquire some of these brands, but it's a sharp group of people at the top of the house who know how to strategically allocate their free cash flow. It's a good company.
Do you have any comments on its valuation right now?
Let's see what its valuation is right now. It's probably come down a little bit. Wow. Okay, I'd have to check at this PE ratio at 17. That there must be something in there that's skewing it low, because typically the PE ratio was in the 20s or 30s. So I'd have to. Honestly, Nick, when I invest in some of these companies, everything is on autopilot. I don't spend a whole lot of time analyzing these companies every single day. The only thing that I really look at on an ongoing basis is maybe a semi-annual and an annual review of the numbers, just a quick cursory review. But I know there's people out there who look at their portfolio every single day. The only reason I look at my portfolio every single day is so that I can see which dividends are coming in.
It's a very good point and something that's important for us to keep in mind in today's digital age. Let's move on to your next company, which is it's a big behemoth financial institution in Canada, the Royal Bank of Canada. What's your investment thesis here?
If somebody is planning, I know you have a lot of listeners who don't live in Canada, and I know that a lot of investors have been burned during the financial crisis because they had invested in U.S. banks. And I guess over the last several years, maybe people have started to dip their toes back into the financial sector. If anybody is looking for to invest in a solid bank that consistently churns out profits and rewards their shareholders, it's a toss-up between the Royal Bank of Canada and the Toronto Dominion Bank. I'm not saying the others are not great, but if there's a finite amount of money that your listeners can deploy, I would start off with the Royal Bank of Canada and the Toronto Dominion Bank. Our RBC, just like all the other major Canadian financial institutions, had to freeze their dividend during the financial crisis, but they didn't cut their dividend like some of the banks in the States. They they held their dividends, and after about 2.5-3 years, they reinstituted dividend increases. So, Bank of Nova Scotia, Royal Bank, CIBC, and Bank of Montreal, they typically increase their quarterly dividend a couple of times a year. TD Bank does it once a year, but their dividend increase is it's much larger. The other banks that I mentioned, like Royal, they increase a couple of times, but the growth for each dividend increase is smaller.
So this is not going to be the last Canadian bank that we talk about in this conversation. So at a high level, what would you say are the biggest differences between Canadian financial institutions and U.S. banks?
The Canadian financial institutions are far more conservatively managed, and when I was working in for Scotiabank during the financial crisis, when things blew up, we were cutting off banks that dealt with us, correspondent banks, and they knew that they had problems. There were some correspondent banks that would come to us asking us to issue letters of credit on their behalf, and we would either outright refuse or we would insist that they were cash secured. I don't think there were any foreign banks that did that to the Canadian banks. I think the banking industry globally knew that the Canadian banks were well capitalized and conservatively managed. The Canadian banks are not nearly as big as, the JP Morgans of the world. And JP Morgan's a great bank, but the level of risk that the Canadian banks are prepared to take on is far less than in the U.S. Now, people talk about, the highly indebted Canadian consumer. They talk about the mortgage levels of the typical Canadian, but A lot of these mortgages are CMHC insured, so there is insurance to back up these mortgages, and the government introduced tighter mortgage qualification guidelines. So if you are purchasing a home and the posted rate for a 5-year mortgage, I'll just pick a number off the top of my head, happens to be, let's say, 3%. The borrower has to qualify on the basis of the mortgage rate being 5%. If you have an existing mortgage, and there is a lot of borrowers out there whose mortgages have to be renewed this year and next year, if you want to switch banks, you have to qualify at the higher rate. If you want to stay with the same bank, you don't have that same hurdle that you have to overcome. So a lot of borrowers out there would probably like to switch banks, but they won't be able to because they won't be able to qualify at the higher rate. So in a nutshell, Canadian banks are conservatively managed, and they've been around. They've been around for ages, and it's not like the States where there's thousands and thousands of banks. In Canada, you have the big six, and then you have some smaller ones. You have Schedule A banks and Schedule B banks. Schedule B banks would be foreign banks that have operations in Canada, but they don't do their own clearing. What they do is they rely on a Schedule A bank to do the clearing for them.
So let's switch gears now and talk about your top 3 holdings. And the smallest of these is 3M Company, which is a manufacturing company in the United States. What can you tell us about 3M?
If your listeners don't know who 3M is, I would be very surprised. The company has been around for ages. It used to be Minnesota Mining and Minerals, and thankfully they just condensed that to 3M years ago. My daughter is big into barrel racing, and the owner of the stables where she boards her horse has been working for 3M for the past 35 years. And he I talked to him and find out what's happening with 3M and how business is going. So he keeps me apprised as to how business is from their end. Obviously, he's not at the top of the house, so he can't see how 3M is performing globally, but they're firing on all cylinders. The stock price has come down fairly significantly in the last several months. If you're a long-term investor and you're looking for a company that is the kind where you can put your head on the pillow and sleep well at night, I recommend 3M. I'm looking at the beginning of this year. It was trading at roughly 250-ish, and it's now down to about 215. And if I'm not mistaken, there was a JP Morgan analyst who came out last year and said that GE and 3M were way overvalued. Well, he was correct on GE, but I think he was mistaken on 3M. I would never put 3M and GE on the same level.
I mean, I can definitely support that. GE has been a nightmare for investors over the past 12 years or so, and 3M has been an absolute gem. So there's definitely a lot of contrast there.
Absolutely. And a lot of that comes down to management at the top of the house.
Absolutely. I mean, General Electric seemed to have a culture that was focused more on quarterly earnings than long-term growth, and I would say the opposite appears to be true about 3M.
Yeah, absolutely.
Turning back to the Canadian banks for your second largest holding, let's talk about the Bank of Nova Scotia.
Well, the reason why it's my second largest holding is because it was my my employer for about 12 years before I retired. So I just naturally accumulated a whole bunch of Bank of Nova Scotia shares. And I think, some listeners would go, oh, well, that was kind of silly. You have your income coming from the same company where you have a sizable portion of your investment. I wasn't really concerned about Bank of Nova Scotia. It's a great bank, and unlike its Canadian counterparts who decided that they would expand into the U.S., Bank of Nova Scotia has shied away from expanding in the U.S. Sure, Scotiabank would do business with companies in the States, and there were some offices in the States so that the corporate bankers could call on U.S. clients, but the number of offices shrank to the point where there's only an office in New York and Houston. There used to be an office in San Francisco and I think it was Atlanta years ago, but they shut those down. Scotiabank decided that they would focus on Mexico and South America and the Caribbean. Actually, they had a larger presence in the Caribbean than in Canada years and years ago. They used to, I think they were actually bigger in Jamaica at one time during the rum running days. So, and some of your listeners, if they go to the Caribbean islands, will probably see Scotiabank branches. They're also big. They're big in Mexico. I think they're the sixth largest bank in Mexico. I'm just going off the top of my head. They are in Colombia, Chile, Peru, not Brazil. That's not a great environment to be in. Argentina. That was disastrous for Scotiabank. Actually, Scotiabank employees had to flee the country, otherwise they would have been arrested. And that goes back, oh my God, I can't remember how many years, probably in the 1990s. So Scotiabank has done well. They have a presence. They have a minority interest in Thanachart Bank over in Thailand. I think it's about a 49% interest. They tried to expand in mainland China and found it was just way too difficult, too many regulations and restrictions. They had a 25% interest in one bank, and they were trying to acquire another minority interest in another bank, but they just knew that they would never be able to own a bank outright in China, so they just pulled up stakes. So Rick Waugh used to be the CEO and was replaced by a gentleman by the name of Brian Porter. Two totally different personalities at the top of the house. So that has created a little bit of turmoil within the HR ranks. A lot of people have jumped ship and gone to work elsewhere. They just didn't like the change in the culture. But the bank is still very successful, spending tons of money on technology. When Brian Porter came in as CEO, he realized that Scotiabank had to, unless you spend money on technology in this day and age, you're just going to go the way of the dodo bird. So the amount of money that the Canadian financial institutions spend on technology is mind-boggling. It's probably nothing near what the American banks spend, but it's significant, like in the billions of dollars on an annual basis. And then the other fastest growing area within the Canadian banking industry is cybercrime and fraud prevention.
That definitely makes sense. I mean, it's one of the biggest concerns for most financial institutions nowadays and businesses in general is cybercrime, just like you said.
Oh, it was unbelievable how many times the bank would have to, they have all sorts of security in place, but it was many times a day where their security precautions were, keeping people out of the systems it was constant. I'd talk to the technology folks, and I think they probably aged faster than most other people in other areas of the bank. You'd look at them 1 year, and then like 3 years later, you'd go, it's only been 3 years. And you'd think to yourself, why do you look 10 years older?
It would definitely be a demanding part of the bank to work in. Now, speaking of financial services and technology, I think this is a nice segue into your largest portfolio holding, which is Visa, which kind of lies directly, at the cross of finance and technology. So what do you like so much about Visa that is, I guess, the impetus behind making it your largest portfolio position?
So if Visa is a new name to any of your listeners, they're living under a rock. Everywhere you go, you'll see Visa. So I invested in Visa about a month after its IPO, and I bought a few thousand shares. So now the average cost is about $14.75, and I'm looking here that the price is $121. And people just think about Visa cards being used when you go to a retailer and you're buying stuff. But, there's all the online shopping, and they bought Visa Europe, so that helped their business. But I was speaking with one of my former team members who went back to India for a 4-week holiday last November, and he said, Charles, you are not going to believe this. I was in the middle of nowhere, India. And it used to be that vendors, if you wanted to buy fruits and vegetables from them, you would pay cash. Now, you pay through a platform that uses Visa or MasterCard as the backbone. And you're buying a couple of bananas, and they're using Visa-related products. So, people think about Visa being in the more developed regions of the world, but Visa is constantly coming out with new products and services that are being used in regions of the world that you would never think that Visa would be. And the other thing too is, when I headed up a corporate cash management team at Scotia, we had a group that dealt with the commercial card, and we would deal with large companies from a procurement standpoint. Instead of sending out checks or electronic funds transfer, would use the commercial card. They would buy sometimes hundreds of millions of dollars on an annual basis from vendors. So they had negotiated contracts with these vendors, and if you had an employee who needed to buy something from this vendor, they would use their commercial card. And so you would get great reporting, which could be fed into the company's system. So you didn't have to key punch things. And then based on the annual spend, the company would get a rebate. So sometimes these rebates, you would be giving the client a 7-8 figure rebate on an annual basis.
That is compelling.
It is compelling. So if anybody out there looks at Visa and MasterCard and goes, oh, they just seem a little expensive right now, honestly, give your head a shake. Are you investing for 2 or 3 years down the road, or are you investing for 20 years down the road? If you're investing for 2 or 3 years down the road, you shouldn't be investing in equities. You need to have liquidity, and you probably don't want to encounter a market downturn. If you're investing for 15, 20 years down the road and you're looking for a solid investment, Visa and MasterCard. Yeah, there's Discover, there's American Express, but they're just not the same. I would love it if China Union Pay were publicly traded, but it's not. So I just decided to go with the top two. It's what I typically do with some of the industries that we invest in. I'll pick a couple of really good players in the industry, and if business switches from one, it's probably inclined to go to the next largest one. So I may as well have a position in the two largest ones. So, for example, I'll own Pepsi and I'll own Coke. I own Visa. I own MasterCard.
The Canadian banks definitely share this characteristic as well.
Yeah, except I just go with the big five.
Yeah, exactly. It's an oligopoly at its finest.
It is.
Well, Charles, I think this is a great place to wrap up. Thanks so much for taking some time to chat with us today. If our listeners want to learn more about you and what you do, where can they find you?
They can go to financialfreedomisajourney.com, and I welcome feedback and input and suggestions on companies to write about. I've recently written a couple of posts that were suggestions from readers. One was on West Pharmaceutical, and I just finished another one before I came on the call with you on Ultra Industrial Motion Corp. They're looking at doing an amalgamation with four divisions from. It used to be an entity that used to be part of Danaher, and what happened was Danaher spun off part of its business into a company called Fortive Corporation, and Fortive at the beginning of March, both Fortive and Ultra Industrial Motion announced their intent to amalgamate four operating companies within the Fortive's business group of businesses. And so I just wrote about them. So financialfreedomisajourney.com. I thank you very much, Nick. It's always a pleasure to speak with you. And I wish your listeners all the very best.
The pleasure is mine. Thanks again, Charles.
All right, Nick. Take care.
Thanks so much for listening to today's episode, everyone. I invite you to check out our website at sureinvesting.co, see our premium investment research at suredividend.com, and also check us out on YouTube, where we publish videos under the name Sure Dividend. See you next time.